Let's talk more Fed and interest rates. Joining us now, Kelsey Berro, fixed income portfolio manager for JPMorgan. And I was thinking about how to start this, but we are used to head fakes in both the economy and in inflation and the metrics that we get. And the minute we think something is a certainty, it seems like our faith is always shaken in anything that becomes a consensus view. At this point, is the current interest rate regimen, A, is it sufficient to slow the economy? And B, will that continue the decline in inflation that we saw?
So I think that the current interest rate environment is going to be sufficient over time to slow the economy. So when I think about the Fed meeting yesterday, I learned three things. One, the bar to hike rates for the Fed is still very high. They'd prefer if inflation is not cooperating with them just to keep rates on hold for longer. And then ultimately, the next move that's most likely is a cut. So with that known, the second thing that I took away is what does it mean for interest rates? Well, if the next move is ultimately going to be a cut, it may be further away, but ultimately the next move is lower. That means there's a limit to how high yields can go, at least in the near term. And then the third, to bring it back to what you're saying on growth and inflation, ultimately it almost doesn't even matter what Chair Powell is saying, because what's really going to dictate the appropriate path is going to be growth and inflation. And I know the concern is that the Fed is underestimating inflation right now, but I do want to highlight how different the environment is now from when the Fed was talking transitory. When they were talking about transitory inflation, the Fed was at zero, at zero lower bound. They were doing QE, and the government was handing checks to people. That's not the environment we're in now. Money is expensive now. Fiscal is still a positive impulse for the economy, but it's less so than it was back then. I mean, certainly, I think we can all agree on that. And ultimately, when I look at data like the jobs report or the JOLTS report yesterday, it shows that job openings are falling, the quits rate is falling, meaning people are not voluntarily quitting their job because there isn't another job out there for them to find with a higher wage. And as a result, wages are declining as you would expect them to, looking at the more traditional economic relationships. You just
described an environment where no one in their right mind could have thought inflation was going to be transitory. They couldn't have been more wrong, the Fed. But you also just took the Fed at its word. Now that you said, well, now we know the next move is going to be a cut. Why trust their judgment on this? How do they know the next move is going to be a cut at this point? And why should we put faith? I guess we're counting on a lag. Do we have to? The lag will work.
We are counting on a lag.
And they are too, the Fed.
That is absolutely correct. They still believe that their traditional economic models will work over time. But I think we all have to be humble about the fact that there are a multitude of scenarios that could occur. But from my perspective, as a bond investor, I want to know, are the yields that I can currently get in a portfolio?
They're not going much higher.
They're not going much higher.
If the next move is a cut.
And also, are they compensating me for the risk? Both the risk in terms of treasury yields, but also the risk in terms of the credit. And everything we hear from companies on the balance sheet side is that they've been preparing for a recession for a year that didn't come, and now their balance sheet health is quite healthy. So when I look at yields in a fixed income portfolio, a fairly high quality portfolio, 6-7%, that's a couple percent above cash. I think that's a fairly good risk reward for investors.
A lot would have to go wrong for that not to be a good place. Probably. It's still possible, but probably not.